Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today it's my highest conviction stock over the next 3 to 5 years. I'm going to give my stock analysis on Valaris. I've finally come out, I've finally thought about it, and I'm going to give my thoughts on the stock evaluation and why I'm so bullish on this thing. So, obviously, nothing I say here is advice, guys. I'm not a qualified financial advisor. I'm not an advisor of any kind. This is just one crazy guy sharing what he does with the world. Please don't act on the information that you hear in this video. It's purely for entertainment/documentation purposes. If you are interested in following my work, you can hit me up on Twitter. It's actually at the Mav Life, but you'll see the handle there. Please do like and subscribe to this channel. All you guys, there's a lot of views happening, and almost half of them are from people that are not subscribed. Please, it doesn't cost you anything. If you get any value out of what I share, just hit the like button, hit the subscribe button. I greatly appreciate it, and it will keep me motivated to continue. And if you want to copy what I do, you can copy me on eToro and download the app, click on the link, and add some funds and hit copy, and that's it. Basically, you have me working for you, trying to grow your capital, and we grew that at 40% last year. So Valaris, here's the one-page overview. They're an offshore drill rigging company. They're the largest in the world. They've got the youngest fleet in the world. They have everything from deep sea drill ships, semi-subs, through to harsh environment jackups, normal jackups, and two legacy jackups, which I don't give them any credit for. Whatever they get for that, they get. Enterprise value today, 5 billion. I want you to keep that in your mind because that's going to be important for later on. And we shall continue I guess the history is a couple of years ago, they, like almost every other offshore company, went bankrupt. They decided to go bankrupt. The market was in a ditch, and they wiped off all the debt, gave it to equity, relisted at around $20. So if you bought at $20, good on you. You're already up, almost 4 times. You could have had a four-bagger in a couple of years. I think there's still a long way for this company to go, and I'm going to tell you why. So here's a thesis on offshore in a nutshell. I've spoken about this probably for the last 2 years, if not 3 years, at least. Offshore capex, so the money that energy producers are going to spend on offshore projects, in other words, giving income to the likes of Valaris, contracting their rigs to contract long cycle offshore oil to get the oil out of the ocean floor, is going to grow at an expected 8% compound over the next few years. There's a very limited amount of competitors now, and the amount of vessels is tapped out. We know how many vessels there are all around the world. They cannot create any more meaningful supply over the next, or at least 2 or 3 years. For that to happen, they will need day rates. My good friend Tommy Deepwater suggests around $635,000 a day, and we're barely cracking $500,000 a day. So we've got a long way for this thing to run. More projects are expected to be coming online and to be sanctioned. That's going to grow at a rate almost double, at 14% compounded annually over the next few years. So very, very interesting. Why are we going offshore? Well, because now offshore break even is for more than 85% of the developed reserves. They're profitable at $70 a barrel. So oil doesn't need to do anything crazy for these things to be profitable. And that's an important thing. I own some energy producers that are highly levered to higher oil prices. They're like long dated call options due to their low declines. And I want to kind of hedge against that through these guys here, the offshore, who are going to be profitable at 70. They are going to, the expenditure from the energy producers is going to be the income for these types of companies, and they're trading at a steep discount to their replacement cost. Love it, love it, love it. So why Valaris? We've got a few options. I've spoken about some of these before. If you're in the private group, the world knows about my call on Transocean back in, I think, 21, if I remember correctly, and obviously did very well out of that, very happy. But now I look at things and I say, Why do I take this extra risk? Why do I take the extra risk on Transocean? It's levered, I don't know, 7 to 1. It's basically insolvent. I expect they'll be fine because day rates will skyrocket. They'll be able to reactivate their cold stack rigs and they'll be printing cash. They're trading at such a steep discount to their NAV. All the reasons I've mentioned on this channel before, you can go and look. But even though I'm confident in that, even though I'm confident my friend Tommy Deepwater has said they don't need to issue any shareholder equity or anything like that, I'm just simply in a position where, you know what, I'm happy to have almost what I consider to be a sure thing. So something with no net debt. It's got just as much cash as it has debt. And I think it's got plenty of upside. So why do I need to take the extra risk? Valaris is the biggest player and it's got the best, almost the best balance sheet for that size of company with those deep sea drill ships. I know my friend Tommy will say Transocean have some specific specs on their ships that no one else has. Fair point. I just don't want the headaches. My leverage, if I want any more leverage, I can go into the options market. But at least the company that I'm looking at here is super solid. Alrighty. Largest fleet, mentioned that. Average age, youngest average age, really, of any of the floaters. And they've also got a decent amount of jackups. Bor has the youngest fleet in jackups, but they don't have any floaters. I like Bor. If you're a member of the ROI Club, you can get my analysis on Bor and how I'm using it to create some option using income or income using options. Okay. Largest fleet, what do they got? 11 drill ships. I believe they're looking to take 2 more, if I'm not mistaken, over the next 2 years. 9 years is their average age. They got 5 semi-subs, ultra harsh jackups, modern jackups, and then these legacy, which are 41 years. So they've, yeah, I don't give them any credit for that. What's this thing worth? How do I approach it? This is just how I approach things. First and foremost, and this is something that I learned really from Josh Young, although it was in a different type of context. I stop and I ask myself first, how much would it cost to build this thing today at today's prices? Now, drill ships, and don't take my word for it, this is some reading that I have done. People are expecting an all in cost for drill ships over $1 billion, okay, with a build time of around 3 years from when everything gets accepted. If you're Valaris, if you're going to invest $1 billion right now with day rates, you know, their average day rate's 394,000 a day, I believe, and your new build economics. Just trying to get rid of this silly thing here. Sorry, guys. Am I going to invest $1 billion in a drill ship that can only get me 394,000 a day expected over, 25%? No way. Why? Because I require 15% IRR on that, okay, internal rate of return over that amount of time. So I'd need a lot of confidence. I'd need a signed contract or a marketplace that really gives me a lot of security to say, hey, if I invest $1 billion as the CEO of Valaris or whoever to build a new drill ship, I want to know that Petrobras or whoever is going to give me this contract and I'm going to be able to earn that way out over time to justify the investment decision. And at the moment with day rates, it ain't there. So when you look at this, if we say, okay, we know what one of these things roughly is going to cost, at least as of 2023, according to this article by Westwood, and we know it's going to take 3 years. So by the time 3 years comes, cost inflation is probably going to push that number up, right? If I can get this 90% utilization, which suggests a tight market, I'll need a day rate of at least 650,000, maybe even 700,000 to get that required rate of return. So if you're Valaris and you're earning cash next year, you're going cash positive, are you going to invest $1 billion in a new ship, which is only going to get you less, single digit IRR in a world where T-bills are paying you almost 5? You're not going to do it. What you're going to do is you're going to say, hey, This means my fleet's trading at, I don't know, or my company's trading at 20% of replacement cost today. I'm just going to buy back the stock. And that is exactly what they are doing. So let's take a look. Here, I think we've covered that. So we know what a drill rig costs. We know the required day rate. We know the hurdle rates, so the IRRs. So I say, how many drill ships does this thing have? And we're going to value them at $1 billion for replacement cost. Now, remember, what they own is not new today. They're a couple of years old, but it'll give us a start. You can discount that however much you want. Okay. So Jackups, they got Jackups. How much would those things cost today to build? And again, using a similar methodology, I am told from what I research and read that a new Jackup could cost somewhere between 250 and 300 mil, and with a delivery time of 2.5 years. So my friend Tommy tells me that the Jackups can come on, they can increase supply a lot more quickly. Okay, fair enough. But 2.5 years is a long time, and our day rates are nowhere near that yet. So a 15% IRR on a 250 mil Jackup, 90% utilization, we expect somewhere a day rate around 200 to 230 per day. Now, Tommy warned me in some DMs. He said 235 would be a bit aggressive. I asked him 235 day rates. What do you think? That's what I'm thinking. He said might be a little aggressive because when the contracts are shorter, it's easier to build these things. They're cheaper and take less time. You might start to see supply increase and more competition for contracts. So maybe 235 is a little bit aggressive. But 200 here, this is not my work. This is what someone else has done in my research, and they say 200,000 a day is reasonable. So let's go with that. Semi subs, a lot harder, but we can use the same methodology. If we extrapolate 2022's average day rates and we want to get a 15% IRR and we think we're going to get 90% utilization over a 260-day working year, which is what I've read some contracts have been, I come up with a guess, that's all it is, of 615 million if you wanted to build a semi-sub today. If you could find a yard to build it, and how long would that take? I'm guessing around 3 years, okay? And there aren't many semi-subs around. I know the argument Ferg has where he says that he thinks drill ships are going to come in. They could do basically the same thing. Could be true. I don't know. But they own 5 semi-subs, and we're trying to figure out what it would cost to rebuild this company from scratch, remember, at today's prices. Is that reasonable? Does it pass the smell test? I think it does, given Seadrill sold one for $500 million in 2017. And that was back in 2017. I mean, what's that, 7 years ago? So I think 615 is reasonable. That's the assumption I'm going to work with. So new build replacement cost, Valaris has 11 drill ships, got 5 semis, 33 Jackups, excluding the old fellas, the legacy. These are the replacement values I'm using. Total cost for each. I think somewhere between $8.25 and $13.25 billion it would take to rebuild this company today. And remember, they got no debt, so you don't have to worry about debt. Here, remember I said that $5 billion was going to be an important number for you to remember. That's what it's trading at. To buy the whole company today, if you had $5 billion, bang, that's what it's trading for. And we think that replacement cost is, as of today, $8.25 to $13.25, depending on which numbers you want to use. So on an asset valuation, this is my very rough back of the envelope idea. If you use, January 8, 5 billion, total new build values somewhere around 22.25, and 27.25. These are, I was reading just the Jackups. So the Jackup value alone is worth more than the enterprise value. If you add up all these fellas, you're looking at 22.25 and 27.25 billion dollars. Sorry, I'm getting a bit excited. So look, at a rough glance, you're looking at less than 20% of the new build replacement cost. As of the current shares outstanding, that works out to be $342 a share. And remember, there's an active buyback process or program in place. And I think that they're going to continue to do that until the stock starts to trade closer to replacement value. Okie doke. Now, there's patience involved. Patience involved with this. Here's the day rate that they've contracted. You'll notice there's not one there that says $650,000 or $700,000 a day for the drill ships. Okay. And that is because we haven't got there yet in the market. Okay. The contracts are still starting to roll over, but they got a lot that are less than 12 months. We've seen that from 2023 to 2022, we saw a 33% increase in day rates in certain parts of the market. I think that's going to continue. We cracked the $500 million mark with Transocean, getting their ship off the coast of Tasmania leased out for $500,000 a day. And so I think we're going to get there. But the contracts are already signed mostly up until around 2025. So I'm looking out into the future. I think that that's going to be a catalyst when these contracts mature and they go to renegotiate. I think you're going to see these numbers on the right hand screen be a lot higher. It's my personal opinion. And what would that look like? So if we take, I guess, a cash flow or EBITDA approach to valuing this thing, we say, okay, their fleet is what it is. If they can get that to, they're using here 80% utilization in the bull case. I think they can get higher than that personally, but that's fine. And these are their average day rates for the different types of equipment they own. So if they said drill ships get to 500, semi-subs get to 400, ultra harsh jackups only get to 175, and so forth. They have these at 80% utilization or 80% booked out, contracted. These are the types of cash flows you're going to see. So you're looking at, let's call it $1.5 billion in a year if we hit these marks, which works out to be about $20 a share. Okay. I think that'll come, I'm saying 26, maybe the end of 25. I don't know. But if you've got $20 of free cash flow per share and it's trading at $68 today, that's a little bit over 30% yield, and so a little bit under 30% yield rather. And so what would a normal multiple be, or what would a normal free cash flow yield be? If you were to just assume a 10% yield or 10% or 10 times multiple, you're looking at a $200 stock if scenario C here plays out. Now, remember, this is going to continue until the fleet in theory gets to 100%, 95% utilized across the board. And this would really only be Transocean, Valaris, and then I think Noble may have a couple of these types of ships. But do you remember we said, hang on a minute, for the supply of the fleet to increase, you really need to see day rates at 650 and not 500. And you need to see jackup for the drill ships, and you need to see jackup rates somewhere above 200,000. So if you were to remodel this, you could start to see maybe $2 billion worth of free cash flow, which would obviously just make this thing pop even further, be closer to $300 a stock on a cash flow valuation. So we've got a couple of scenarios. If you're entering today and you've got patience, using an asset, using a free cash flow multiple, if you're looking at 3 years IRR of 43%, if you get in today at 68 and you exit at $200, should everything happen the way I'm saying. If you have to wait 5 years, is that the end of the world? Well, 24% IRR that works out to be. I certainly don't think so. And you're doubling your money every 3 years at that rate of return. So I would be happy with it. And you would have you'd be pretty happy with it, surely. If this company were just to get back to, quote, replacement cost today, replacement value, that value I estimate around $342 a share if you use the new build valuation today. If you say that happens in 3 years, I think that's too aggressive. I wouldn't expect that to happen. But in theory, it's a 71% IRR. Again, if you have to wait 5 years to get more than 5 times your money, that's a 38% IRR. Now, I know that this is new build cost and the vessels they own are not new, but they're also not very old. So throw a discount on there. Give it a 50% discount. Give it a, I don't know, a 30% discount to what I've done here. The yards are tapped out for 3 years or more. And it's going to take billions of dollars of investment that these companies have. And they're not going to do that. Everyone's got PTSD. They're not going to do that until their company and until it doesn't make sense for them to buy back their own stock or dividend out the money to the shareholders. And so that's my thesis. That's what I think is going to happen. And so, yeah, we've got one more little scenario I'd like to bring to your attention is that the reason this thing is, or one of the reasons this thing is so cheap is that analysts really aren't understanding the picture. So you can see at the top here, analysts are estimating its earnings, and earnings is a bad measure or unit of measurement for these companies because they've got all sorts of things to depreciate, and it's further down the income statement and blah blah blah. The point is, this is what analysts thought was going to happen, and this is what actually happened. So they beat earnings this particular quarter by 655%. Okay, so the analysts are way off. So take the analyst numbers, throw them away, do your own research. Here again, you can see this is the contract log. I've just taken this from the quarterly pres of the company. This is what they're currently earning on their floaters, their drill ships and their semis, which we can see. So 389 in 2025. They're going to make some money, but we're not going to get that real inflection. Come 2026 and 2027, I expect that to be closer to 500 average. Maybe even 650, closer to new build economics. Probably take a little longer than that. And your jackups have got to double. Yeah, jackups have got to double from here. 109,000 is too low. And those contracts roll over more quickly. So I think there's a lot of upside to come. Personally, I'm long the stock in many different ways. In eToro, I'm going to build it up to around about 10%. My private portfolio, I'm going to build it up to something similar. And in my options portfolio, I'm going to do exactly the same thing. So again, my thesis, not advice. I'm long the stock. It's a cyclical, opportunistic play. I'm not going to hold it forever, but it's got no debt. It's got a shareholder return program in place that will continue until it hits replacement cost or close to. My estimate of replacement cost, given what I can see in the economics of this sector, is it's worth somewhere around $300 to maybe $342 a share. So until we get close to that, I'm sitting back. That represents 5, maybe 6 times my money as of today, not using options, not using any other form of leverage. And I think it's going to happen in 3 to 7 years. I can afford to wait. I can afford to wait that long to quintuple my money. It's not going to be too exciting until the end of 25, I don't think, because the day rates are contracted in. But when we hit that inflection point, expect some fireworks, much like you saw with Transocean at the start of last year, 2023. So that's it. No new builds on the horizon. It'll take 3 years and double the day rates for average day rates that the company has for that to happen. Trading at less than 20% of its replacement value with its free cash flow about to explode. It's my thesis on Valaris. I hope you like it. Let me know what you think in the comments, and I look forward to catching up with you in another video another time. Take care, do your own due diligence, and I'll see you then, guys. Take care.